Greetings. I'm Steve Dubb. He and him are my pronouns. I'm Strategic Initiatives Editor here at Shelterforce, coming to you today from Boston on land historically stewarded by the Massachusetts people. For this webinar, what does a good housing impact investment look like? We will explore the mechanics of impact investing, including what works, where and why it falls short of its goals, and how to apply the principles of the forms of impact investing that are effective to better meet people's needs. For our webinar, we are joined by 5 expert panelists: Betty Francisco, CEO of Boston Impact Initiative, a CDFI that supports what it calls Impact First Investment, both directly in Boston and through a national network. Meredith Levy is Executive Director of Boston Neighborhood Community Land Trust and partners with Boston Impact Initiative. Kate Khatib is Co-Executive Director of Seed Commons, a CDFI that supports worker cooperatives nationwide. David Lids is a worker owner at the Water Bottle Cooperative in West Baltimore and partners with Seed Commons. And last but not least, my colleague Shelby King is Shelterforce's investigative reporter based out of Colorado. A few notes. First, please feel encouraged to use the chat to introduce yourself, as well as to pose questions to the panelists. We will dedicate the last half hour of the webinar to your questions. Second, we often get asked if we will share the recording. We will share the recording after the webinar, so please don't ask. That will be provided. We also publish a transcript of the webinar within about a couple weeks of the webinar. Lastly, if you're, the webinars are free, but they're not free for us to put on. So please consider making a donation to Shelterforce today. And with that, I'm going to pass the baton to Kate Khatib of Seed Commons. If you could briefly introduce yourself and your organization and talk a little bit about your work. Thanks.
Yeah, I'm happy to do it. Thanks everybody for being here. As Steve said, my name is Kate Khatib. So I'm the co-executive director of Seed Commons. Seed Commons is a national CDFI loan fund that is cooperatively governed. And we work through a network or through a cooperative of 40 locally rooted, community-led organizations spread out all around the country to steward a shared investment fund that is used to make what we call non-extractive loans or non-extractive investments into cooperative enterprises that are spread out all around the country. So as I said, I'm based in Baltimore, Maryland. Baltimore, Maryland is one of our largest sites in the United States, but it's one of 40 organizations, 40 member sites that are doing the work of using and co-stewarding this national investment fund to be able to support the work of cooperative enterprises. So we were founded to do really to fill a gap, which was access to small business lending for worker co-ops, right? So worker co-ops are businesses that are owned and operated and governed democratically by the workers in the business. It's really hard to get financing as a worker-owned cooperative. A lot of banks feel like it's a non-traditional ownership structure when you have 20 people who work together to own a business and to operate it collectively or democratically. And so we were finding, and including me as a worker owner in a co-op in Baltimore. So I'm a worker owner at Red Emma's, which is one of our Baltimore-based cooperatives. It's a restaurant and a bookstore. It's been around for 22 years. Our co-op was having trouble getting access to financing because of our ownership structure. And so we kind of struck out and found folks all around the country that were experiencing similar problems, similar challenges, getting access to just typical small business lending to be able to support their worker-owned co-ops. And Seed Commons, and then this national CDFI, grew out of that experience of worker co-ops. Over the years, we've started to shift and develop a practice of lending in other parts of the cooperative ecosystem. So we were founded to work with worker co-ops. It's still our heart. It's still primarily where our work is focused. We also will work with different kinds of community and cooperative ownership vehicles in the real estate space, producers, cooperatives, farm cooperatives, and so on and so forth. So I'm excited to be here and to talk about some of the work that we're doing in Baltimore, and then some of the national lessons that come out of that.
Thanks, Kate. David, could you introduce yourself and talk a little bit about Water Bottle?
Sure. My name is David Lids. I am a worker owner of Water Bottle Cooperative, and I wear a few other hats with entities that are related to that ecosystem. One of those entities is a construction company called Appalachian Field Services. The field services of that is related to mortgage field services, which is the business of maintaining and managing foreclosure stock for large financial institutions like banks and Fannie Mae and FHA. And to get to that entity name, it starts with me getting sober in 2002 and coming out of rehab with a tarnished record, maybe you might say, and having trouble getting work and going to 12-step meetings on the west side of Baltimore and seeing beautiful, vacant, crumbling row homes and Victorians, and just being really puzzled at how this could be, how there could be all this beautiful architecture and gorgeous housing that is just falling apart in a major United States city. I started poking around in those buildings because I guess I hadn't had enough scuffles with the police yet, just out of curiosity. And one time I was doing that and I bumped into a crew that was doing what's called a trash out. And that is one of the things that you do when you're in the field services business. You clean out the properties, and then there's a fairly limited set of other services: boarding up, changing the locks, winterizing, cutting the grass, tarping the roof. Anyway, these folks asked me if I was interested in working. They didn't care about my background. I said yes. I turned that little moment into a little contracting company of my own, and when it came to time to hire up, I did what I was hearing in the rooms of recovery, that in order for me to stay sober, I should offer what the universe so graciously offered me in my moment of need to others that were trying to also lift themselves up. And never heard the word social enterprise or impact investment back in 2003 and 2004. But before long, this is what we had. We had a construction company that specialized in this work and used the work to hire and train up folks that are trying to put their lives back together again. Along the way, we discovered we were spending a lot of time in what we are now understanding to be disinvested neighborhoods. A lot of bad stuff that we saw, including the way that we, the workers, were treated, and also the way that these neighborhoods and the residents of these neighborhoods had been treated. So we came up with this idea that we could go out and get us some of this impact investment that we were hearing about. Eventually, a few podcasts and a few news articles later, I bumped into Kate Khatib, and I reached out, and Seed Commons got behind this idea that we, this scrappy group of workers, could stand up a real estate portfolio that would lift neighborhoods and keep equity in the community. And I'm going to stop it here. We can get into the deep parts of this, I hope, later. But today, because of Seed Commons financing us up to the tune of about $6.5 million now, we have 30 assets, and 20 of them are fully finished and rented. And there's just like 18 bullets of incredible impact that has come out of the impact investment that Seed Commons showed up with. So thank you.
Thanks, David. And it's not surprising you hadn't heard of impact investing back in 2003, because the term was coined in 2007. So that would have been difficult. But thanks for that presentation. Betty, could you introduce yourself and the work of Boston Impact Initiative?
Sure. Well, Steve, thanks for the invitation. Honored to be amongst this amazing group of colleagues. I've been at BII for 5 years now. I joined the organization back in 2021, just coming out of COVID. And part of my motivation, having been a corporate lawyer for almost 20 years, was that I wanted to be part of shaping a new model of funding that cared more about the investments and the people behind them than the profits going to investors. So that was the key motivation, was flipping the script on who gets to benefit, right, from profits. So BII is a nonprofit impact investment fund, and we are now a certified CDFI, Community Development Financial Institution. We were certified last year. And our mission is to invest in people and places that are building community ownership, shared wealth, and economic power, with a focus particularly in communities of color. So what does that mean? We basically invest. So we lend, and we also do equity investments into small businesses, cooperatives, community-owned enterprises. We focus on providing fair and flexible capital, so fairly low cost. Oftentimes that means it's below market rates than what a bank might charge. And we couple really flexible capital, both debt, equity, and grants, with business coaching, technical assistance, advisory, connections to trusted networks, and which is what we call social capital, so that we can help businesses launch and grow. We started investing when BI first started in Boston. I'm based in Boston. And over the years, we've expanded our investment footprint into Eastern Massachusetts. Now, as the CDFI, we invest across all of Massachusetts and selectively in New England. Since our inception, we've deployed over $20 million into over 100 enterprises across New England. And when we launched our second fund 3 years ago, we wanted to deepen our investments in real estate, particularly in real estate that advances community ownership or governance as a tool to prevent displacement and build wealth through ownership of real assets. I would say what we're best known for in terms of our investment approach is this integrated capital approach, right? So we try to play with all the tools in the financial toolbox, not bucketing ourselves into just, providing debt or providing grants. So we play with all of the financing tools, from, straight term loans, lines of credit, to royalty-based financing, and also doing equity and near equity investments. We've taken all of our learnings across, many years of investing. And in 2020, we launched a fellowship program because we were getting a lot of requests from leaders across the country to share our model, because others wanted to replicate it and start impact funds modeled after BII, which is a charitable loan fund. And so we've trained now over 90 impact fund managers to launch community-based impact funds. 29 are raising across the country, and they've already deployed 60 million. We have this goal we set to have these funds move 100 million in capital by 2030, and they're really in a great position to hit that goal. I'll stop there and share more about BII as we have the conversation. But thanks for having me.
Thanks, Betty. Meredith, could you introduce yourself and briefly introduce the Boston Neighborhood Community Land Trust?
Sure. Thanks, everybody. Great to be here. Meredith Levy, the Executive Director of Boston Neighborhood Community Land Trust. We actually started in the foreclosure crisis after 2008 as the Coalition for Occupied Homes in Foreclosure. And our single most important, the core of our mission is to make sure people can stay in their homes. So throughout our history, starting with foreclosure, leading into massive housing inflation and gentrification, and also COVID, a lot of the same folks in the neighborhoods where we work were getting hit and squeezed and getting pushed out of the neighborhood. So our mission really is to make sure we can take properties off of the speculative market and make sure that they are permanently affordable. So not 10, 15, 20 years, but forever. All of our properties, we became a land trust in 2019, 2020, and that's when I started in my role. All of our properties to date have been rental properties. So that introduces another finance question, which I might bring up later. But as a land trust, we're also very committed to having integrated types of housing available for people as people build their own, they're on their pathway towards some sort of ownership, where ownership can be defined as governance and control, collective control, all the way through individual ownership of a home. And there are lots of steps on the way. So in that change right now, what we're doing is we're building, in addition to acquiring properties, we're building a new property. It's a 6-unit building that we're doing with investment partners. And that's what we'll talk about in a bit, which includes BII. So we'll get into that. But we have about 32 folks who live on our properties. And this is hard work to do. We acquire small properties like triple deckers or small properties. It is some of the hardest housing to finance because we don't have access to the LIHTC, low income housing tax credit, or other big deals. We are always trying to open up, turn over rocks and look for new ways of doing things, because a big piece of our work is to address the systems that just frankly don't work and find alternatives. And we're not just going to find them on a shelf somewhere, we have to build them out. So we consider ourselves a big partner in this whole solidarity economy network, working with the practitioners like the folks here to do the impact investing and constantly find other ways of doing this, so that in the end, the folks who are really in charge of the housing and the neighborhoods are the people who live there. Okay, I'll stop there. Thank you.
All right, thanks, Meredith. And Shelby, introduce yourself and talk a little bit about the series that you're working on this year on the affordable housing, or the failing or at least suffering affordable housing business model.
Sure, thanks. Thanks, Steve. Hi, everybody. I'm Shelby, as Steve said, Shelterforce's investigative reporter, and I am here on this panel because I am reporting all of this year on a large series that kind of looks at whether the traditional business model for building and operating and then preserving affordable housing is still working, and what happens, hopefully, to tenants is what I'm mostly focusing on when it doesn't work. And then also what happens to the providers and what folks are doing to kind of make ends meet where they don't. So I'm really interested in hearing what everybody has to say about the different impacts that their investing is making and the different formulations that they're putting together, the different toys that are there to play with, as Betty said. I like that. And so I think a thing that's interesting to me is that impact investing, like we've heard from the panelists so far, means different things to different people, whether it's the impact on the people who get to make the profit, or is it impact on the property itself, or is it impact on forever affordability. So I'm here to just kind of ask questions as they come up and really learn about what y'all are doing. So thanks for inviting me, Steve.
Oh, thanks for coming and being here. I will start with a question. This almost falls directly on what Shelby just said, actually, but it's, what is impact investing? It's a term that was invented in 2007, although obviously the practice predates it. And what is its promise? And, to what extent, how can realizing that promise make affordable housing available to more people? Like, how can it have real impact in the real world, I guess, is kind of the question. And Betty, I'll throw it to you first, and then we can see who else wants to jump in.
Yeah, no, that's great. I mean, everybody will have different answers to this, right? Which is what I love about impact investing, because it is a big, wide spectrum of types of investment, right? There's every investment, if you think about it, has some impact. But what we're talking about, investments that have positive impact, right? Positive social, economic, environmental impact. And I think of it as using our money to right the ship, to create the world you want to see. So in essence, impact investments are designed, right, to have positive social and environmental impact. And I would say to build a more equitable, inclusive, and sustainable economy. At BII, or if you think of impact investing as a spectrum, where at the very left, it's investments that have impact, so positive social impact, but they really prioritize financial return. We're at the sort of the right side of the spectrum, where we want some financial return, but we really prioritize the impact return of the investments that we make, right? So some of the things that we look for in terms of what are they advancing from an impact perspective, one is increasing wealth and asset building, particularly in communities of color. And that could be with a real estate investment where there's an opportunity to own at an affordable price. It could be getting capital to a business owner, right, that just lost their SBA loan because they're an immigrant, right? It could be supporting a cooperative, right, that is now trying to scale up and can't otherwise get capital from a bank. So it can take many forms in terms of building wealth for entrepreneurs. The other is governance, right? So we want our investments to grow social and political power, especially for workers. We want to prioritize investments in democratically governed businesses when possible. A big one for us is also jobs, right? Are we creating good jobs that pay living wage, that offer pathways for ownership? And then lastly, climate resilience is another big piece. So our investments, right, prioritizing clean energy solutions that build resilience in community. On the real estate side, you know, as I mentioned earlier, the focus is on investments that build community ownership. And that can take many forms, right? Where maybe tenants have an opportunity to own as a pathway, right, for building wealth. It could be that they're preventing displacement in neighborhoods that are rapidly gentrifying. But we're weighing both, right, wealth building with community decision making. So for us, that's how we're prioritizing the impact of our investments. And again, with a focus on the impact versus the pure financial return of it. And later we'll talk about what does that mean, right? What do you have to do in order to allow us to make these kinds of impactful investments? And that means the kind of capital we have from investors, right? It has to be low cost so that we can in turn make affordable investments in these projects.
Thanks. David, I thought you might want to jump in here.
Yeah, I think a great place for me to start is where I left the story, which is before we met Kate and Seed Commons and the Baltimore Roundtable for Economic Democracy, we were making this move to try to buy these crumbling row homes and restore them as our own developers. And we were using the vehicles that we knew from that nasty little niche of the American finance system, which is credit cards and a thing in real estate finance that's called hard money or private money, which back when we started like kicking around this idea and trying this stuff out in 2008, 9, 10, 11, the hard money mortgages, these are mortgages I'm talking about, the rates on those were like 15%. And then when you fell behind a little bit, they shot up into the 20s on a mortgage, right? And why we using that product? Because that is the type of investment that you get in disinvested neighborhoods, right? Today the rates are different, but what that describes is this extractive investment product. And then of course the other thing that we used is credit cards. So whatever, 25 to 45%. So when our first moment with Seed Commons was Seed refinancing the 3 properties that we had already bought from those crazy rates down to a main real estate investment product that at that time was 3%, 30-year amortized line of credit that allowed us to both acquire and renovate. So like another discussion to get into the weeds about just how supportive that was. But needless to say, it was great. And I love the list of impact that Betty just described because Seed provided us that kind of impactful investing. Everything that Betty just listed was possible. So one of the first things that happened is we went from being workers who were, bottom run workers who this is really hard, shitty work that is grinding and dangerous and terrible pay. We went from being that to being workers who were getting good pay and starting to receive benefits and starting to slide into an ownership position of this whole enterprise, starting to realize training opportunities and leadership opportunities. So the workforce opportunities were amazing. And then there's all the stuff that you would expect, which is we were completely gutting these houses and renovating them. So we were restoring these homes, these 100-year-old homes to dignified housing that will last another 100 years. And then because of this rate, we were also able to put those houses out on the market at affordable rents. We use sort of a mixed income strategy, but when you look at our mixed our mix, it's like in this market, it is like all affordable. But and that was all made possible because of this product. So and then like we could go really deep into all of the other pieces that Betty was touching upon too. So we are also describing a product like Meredith described, which is this is a rental portfolio. We're not trying to fix and flip. We are trying to create a portfolio that is owned by the workers that have invested their bodies and their time and their spirit into renovating these neighborhoods, most of whom are marginalized workers. And then as we stand the thing up to bring tenants and other neighborhood stakeholders into an ownership property of this portfolio. So we liken it more to a real estate investment trust. We call it an impact real estate portfolio. So not quite a land trust. It looks a little more like a real estate investment trust, but you are achieving that kind of community ownership and anti-displacement, which I think is a more lasting formula than a traditional government subsidy that comes in, funds a developer to fix a property up, and then sell it once at affordable rates, because the next sale is prone to gentrification. The last thing I'll say before I let my moment go here is I also, I will probably start using the word like concessionary. And I don't know, it bugs me a little because what I just told you, so certainly the rate that Seed Commons presented us, Kate will talk about how Seed Commons was able to present that, because they're definitely lower than market terms. But when we describe all the impact that Betty and I have just described, these are all things that we normally called externalities. In this case, these are positive externalities. And the other way that we could look at it from the extractive side is the negative externalities. So the positive externalities, the impact is so mind-blowing. It's a little troubling to call it concessionary. But granted, let's just say, well, these aren't market products, so they must be concessionary. Again, I don't think they have to be. I think the market products are looking at one kind of investment thesis, which is short-sighted and looking for the most IRR in the shortest amount of time. But you don't have to do that. If you're looking to invest in a neighborhood over 10 years or so, and you have good faith, that good idea that neighborhood is really going to rebuild, like why not get in for 10 years and still see like a similar return to the extractive way that you would get in a 3-year. And then also, I swear, last thing, we think Kate is going to get into this and get into the slides. I think 30 to 50% subsidy in our capital stack is what we need to really like make all of this work. The infrastructure, the buildings that we're rebuilding are buildings that are already there and they live on existing infrastructure. I think when you study development out here where I am right now in the exurbs or in the suburbs, there's a ton of government money that goes into laying down roads and infrastructure. And there might be some public policy wonks in the room that know what that number is, but I'm pretty sure it's like somewhere between 20 and 40% government money goes into subsidizing new development at a much higher per square foot construction cost than we're realizing in the rebuilds. So just another way that it kind of bugs me, like out here in the exurbs, that's just called housing subsidy. In the city, it's perceived as charity or like something different. That's it. I'll shut up.
Okay, thanks, Dana. Appreciate it. So I think I want to jump, before we go to the case studies and the slides, there's this question from the audience I thought was important, which is, there's a lot of, we'll just say bad impact investing, right? So it's sort of, does there need to be, this is a question about webinar about what is a good affordable housing impact investing. So does there need to be some kind of minimum standard that defines what qualifies as an affordable housing impact investment? Because, there are plenty of folks who claim impact and it's sort of like, well, I get my normal market rate return and I feel good. But it's not actually filtering down. So just wanted to see if there were any thoughts from the panel on that. And then we'll go to the case studies.
I'll make a comment. When we were first adding real estate, right, as a category within our fund two, this was a really good thing we grappled with as an investment committee and board, right? What's deep enough? And it's not that we say it has to be this or that, but when we look at individual opportunities, we look at, how deep is the affordability. So we want to go as deep as possible, 30% AMI and up, right? So because there's a lot in the 80%, but we want to go as deep as possible to really support, the most vulnerable residents, right? So I think we can do that because we can provide capital that is, really affordable. I think if your thesis is we got to return, 10% back to investors, then your return profile is going to be very different. And it doesn't mean you don't have an impact, but it's just a different level of impact.
Yeah, I think that's exactly right. And I think as we start to get a little bit more granular about what we mean when we say impact, right? And we're not just talking about the who, and we're not just talking about the where and the how much, but we're actually talking about what does that housing look like? Are we prioritizing healthy inside environments, right? Are we actually strategizing around ways that we can bring more environmentally sound building techniques into neighborhoods that have particularly poor air quality, right? So that we're not a part of making a problem worse. We're actually starting to bring in new techniques. I think that there are a lot of different levels of expectations and requirements that we can kind of put into the subsidy or the models for affordable housing funding. I think the challenge is that every neighborhood is different, every property is different, and who is going to be most impacted, who are the end users, what are the criteria that you actually want to be looking at. It's going to be different in every one of those contexts, and we found that even funding across Baltimore City, we work on a number of different affordable housing projects in very, very different neighborhoods of the city, all of which are historically disinvested communities. And what we find is that some of the criteria that we apply in South Baltimore are it's just different criteria than the criteria that we're applying in West Baltimore. So I think it's one of the challenges. I mean, I understand the point of the question is like, okay, but how do we make sure that actually subsidy or what's called affordable housing subsidy or impact investment is actually really making an impact? How do we quantify that impact? But I guess the thing I'll lift up is that even for those of us that are working in really deep impact models and have the ability to do that, it's sometimes hard to quantify what exactly those standards are going to be. It's important that there is some level of bespoke analysis of every individual model and every individual project.
All right, thanks.
Can I ask a quick question, follow up there? Is there any space or logic behind taking like the current interest rate, for example, even as simple as saying, like, if market rate returns are 10%, and I don't know what they are, I just guessed that because 10 is a round number, but if market rate returns are 10%, then you're an impact investor if you can get down to 7%. You're an extremely impactful investor if you're only looking for 5%. But what we really need is 3%. So what do we call that? And is there space in there? Because that's a standard, we know what the standard interest rate is. And if we tied what impact investing means to how much cheaper the money is, then would that be a good standard to go from?
I want to just say a quick thing. From our perspective as a borrower, I think we can be really clever in how we design risk mitigation, which we're going to go into in our slides in a moment. but we can entice impact investors to bring down their interest rate if we can put in place other ways to mitigate the risk. And that's really important. And also, like, we're working on a different way to finance a 10-year, I'm going to bring this up later too, deal, but we're working on a blended rate. So we might have some impact investors who are coming in at 0% actually, and our highest investors at closer to 5%. So we're working on a 3% blend, which as the end user, that works. If we can be creative about how we mix and match, I think we can get to the goals. And we can, just as the lenders are thinking about how to treat different areas of the city differently, we as the borrowers can also think about different kinds of impact investors and how we bring them together to meet that singular goal.
Great,
I think
thanks.
what you just said about risk in there too is worth lifting up, just to simply say that it seems to me like it is time in the field, just in general, to reassess risk and who carries it and how much is risky and what is risky and why are we still calling things that were risky 30 years ago the same type of risk when we live in an entirely different world.
I have so many things to say about that, but I think Steve wants us to maybe move to some of these case studies so that we can show you what this looks like in practice. But I'm hoping we can kind of come back to that point.
And I certainly concur with the need to revalue risk. It's something I've talked about for years. Yeah, so why don't we'll start with Baltimore. So I don't know, Kate, I think that's you doing it with David. If you could talk about how you de-risk that project and how it's structured, that would be great.
Yeah, totally. Let me share my screen here. Yeah. Let's hope this works. All right, is everybody seeing the orange slide here? All right, so we're just going to quickly take you through an example project that Water Bottle and Seed Commons and our local Baltimore member, which is the Baltimore Roundtable for Economic Democracy, are working on. This one is for us, I think it's a little bit of a representative project because it's a little bit more ambitious than some of the other projects in the portfolio, but it represents a pilot and a model for what Water Bottle is hoping to be able to do moving forward. David, do you want to talk a little bit about 1901 and just give people a little of the context of what they're looking at, and then I'll take us through the financials?
Sure. 1901 is a 3-story row home. So when I described that journey where we went from doing trash outs and window boarding to being renovators of fully renovating row homes, we started, that was a gradual process. And so the early stage, we mostly did 2-story units. And I think this is what Kate is saying, when this is a much more ambitious one, it is 50% higher and more space. But it is just another floor of what we normally get when we buy a house. This is the way we like them. The reason we like them this way is there aren't many, we don't get much competition at the auction site. There are not that many developers that are willing to take on a building that looks like this. This one looks pretty good, by the way. And so we can get it pretty affordably. In this case, this one is $43,000. The 2 stories, I think we're still getting for like $25,000. And then this one, in this case, we're going to develop it into a 3-unit building. And I guess the other thing that Kate will get into in a second is Seed Commons managed to secure some of the Greenhouse Gas Reduction Fund funding before some politicians scratched all that money back. So we have money right now to pivot from just doing social and economic justice kind of impact to environmental justice, which is just awesome. We wanted to do that for so long, but it was all we could do just to stand up the cooperative and become developers. But we have money to use this and another property, a 2-story, to learn how to do what's close to passive construction, so tight envelope with high efficiency mechanicals, with the aim of getting down to a near zero carbon footprint or a near zero electric bill or maybe a negative electric bill. And the last thing I'll say about it is This is on the corner of Route 1 and Route 40, which if you're familiar with the East Coast, the Mid-Atlantic, this is like a major intersection. And it just, the positive about that is we got it, and we have 3 other buildings right on this very block and 16 right in the blocks around it. So that is really cool. But the negative side is like, how did we let this beautiful building on this very major intersection of the United States of America turn into that?
Just to give you a little bit of context of where we are in Baltimore. So this is in West Baltimore. For those of you who followed what was happening in Baltimore in 2015 during the Baltimore uprising that came out of the police murder of Freddie Gray. This is Freddie Gray's neighborhood. So this is right near the area of the city that he grew up. It's a deeply, deeply disinvested neighborhood. And in fact, it's one of the parts of the city where redlining really started in Baltimore. And so there's a lot of challenges around rebuilding the housing stock here. All of the time, we get these questions from people of like, wouldn't it just be easier to take these blocks down and start fresh with new construction? And on some level, it might actually be less expensive, but there is also historic value in being able to work off of the shells of these buildings that were actually really built to last a long time. This particular kind of brick construction has real staying power. It's why you have buildings that still have shells, despite the fact that the interior pieces have started to decay away. The problem is that you also require a significantly larger amount of investment because there is so much historic disinvestment. Once you get a building that's at this stage, there is a tremendous amount of money that has to go into actually rebuilding it because it has been ignored for so long, because it has been disinvested for so long. So we're already fighting a little bit of a challenge, right? If there had been earlier, if Water Bottle had been around 50 years ago and was able to get access to the kind of financing they've been able to get access to through Seed Commons and other partners, perhaps these buildings could have been saved with a smaller amount of money. At this point, we're now talking about really rebuilding the entire structures. So here's what we've got. This is where we are right now with 1901 West North. This is the financial model that we're working with. So was a $43,000 acquisition. The renovation costs are going to be about $516,000, but we're also building this again using some of the most environmentally sound materials that are broadly available. So we're trying to do this with mostly off-the-shelf products to demonstrate that it can be replicable. That takes us to a total price of $700,000 just to get this thing to the point of occupancy, right? So to acquire it, to renovate it, and to do the efficiency upgrades, it's around $700,000. Seed Commons is providing the senior debt for this deal. So we've modeled it at 5% amortized over 30 years. As David said, a lot of the other properties in this portfolio are financed at 3% amortized over 30 years. That's really what it kind of takes for it to work without any subsidy in the deal. We are trying increasingly to bring more subsidy into these deals because we're starting to just understand to really build to the quality that they want to be able to build, to be able to provide the end occupants with a great place to live, to really focus on increasing the health of the tenants by using materials that are safe and sound. We do have to start bringing subsidy in, and we also have to start understanding that there's other capital out there that we might be able to access if we're able to show models that can actually support a 5% interest rate, which again, Seed Commons like Boston Impact Initiative, we are fortunate to be able to have more flexibility, to be able to come in at lower rates, to not be able to worry about as much of a return because of the way we structure our contracts and our relationships with our investors. But for this, we're actually modeling this out at a higher interest rate. So this project can afford to carry about $450,000 of debt at those rates. We have this $50,000 GGRF pilot grant that David mentioned. And then we have a couple different kinds of state subsidy that are coming together. There is a new development initiative aimed at vacant properties in Baltimore City. These properties, this house in particular, is in the catchment area for that. So we're working with state subsidy to bring the ultimate cost down, the amount of debt that's required down. And then this will be retrofitted into three units, each rented at about $1,300 a month. And we're just showing you what it takes for this to break even, right? So the overhead plus the mortgage payments at that $450,000 of debt, we can just cover that with the rent that's coming in. So this is what it takes just to make it work, right? Not to make it profitable, but just to make it work. It's taking around 35% subsidy. Now, we could choose to build this a little bit differently. We could take out some of the efficiency upgrades. We could do just a more standard build, and we could maybe make that work with 20% subsidy. But it's still going to take subsidy, right? Just to get it to the point of occupancy because of the amount of investment it takes to really go back and rebuild these buildings that have been just left as a result of disinvestment, as a result of redlining. It just doesn't work without the subsidy.
Meredith, you want to do the case study for you guys and talk about how you're putting it together?
Okay, so first of all, just to nod, I would love, there's so much storytelling and thinking about the rental properties we've used, acquisition loans leading into more permanent financing, a different story, but we're very familiar with that. And then there's the subsidy both in acquisition, but also subsidies that the tenants can get access to. So lots of challenging questions there. But what I'm going to present to you today is our 355 Park Street project, which is we're a community land trust, and this is our very first home ownership project. And we're building from the ground with our development partner, Co-Everything. And this building that you see here, this is just a sketch of what it's going to look like because we haven't built it yet, happens to be right next door to one of our triple deckers, which for us is really great because there's an opportunity to really create this conduit of buildings that we own to better connect the residents who live there, as well as to have much more stewardship, eyes on the ground of that particular block. So yeah, we're in the process of building it. I won't tell you too much about it, but they're going to be great energy efficient projects. They're all affordable. And it's 6 units, two bedrooms, 2 3-bedrooms, and 2 1-bedrooms. So one of the unique things about this is that we're really leaning into the partnerships. Like I said, we're partnering to develop with Co-Everything, but our lending team is also 4 different partners playing that role. Typically, you would go to one lending partner, but in fact, we are working with Boston Impact Initiative. Betty's here, and she'll speak about this as well. LEAF, Boston Ujima Project, and the CLT Fund. And I'm going to show you the capital stack in a second, but having 4 impact investors who are non-extractive and really familiar with Dorchester, where this building is in Boston, makes such a big difference. Okay, going to the next slide. So here's our capital stack. So basically, we have secured commitments from these lenders. And if you notice the top, so we have LEAF, BII, Ujima, and the CLT fund at a senior level and a junior subordinate level. The first 4 are secured, and this last one is subordinate. I want to say something also about the CLT fund. We, BNCLT, are part of a network, the Greater Boston CLT Network, where we spent some time really building out this new fund, and it was seeded through the city. The city of Boston gave us the initial money to put together this fund. And the beauty of it is that it's governed by the community vis-a-vis the community partners who are involved, the CLTs. So it allows us to be really, really flexible and use the money where it is needed most. And that gives us a tool separate from your conventional lenders or the lenders out there because it's internal. So we get to build it and shape it as we wish. So that's been really, really valuable. So actually the CLT fund is playing multiple roles in our capital stack because they're also offering some subsidy. And then you'll notice the city of Boston. They came in with well, close to a half of what the project costs are. And generally speaking, for our preservation properties, as well as for this, we really count on between 30 and 50% of subsidy coming from the city. And this is in the form of a soft loan. So as long as we hold on to those restrictions that are part of this and that we have the long-term affordability, we won't have to pay that back. So that is our subsidy. We did get a grant source from ARPA, remaining ARPA monies that originally came from the city, but they were moved into the CLT fund. And that it helped us also get to the finish line. So another thing to note here is, we'll get into this in terms of risk mitigation, but we as developers, we're taking 50% of our overhead fees at closing, but the remaining 50% of overhead, as well as our developer fee, we're deferring and we're going to be paid back last. So that serves as a backstop, another strategy to mitigate against risk. So the lenders will get paid before we get paid. Okay, so I'll stop my share and we'll talk a little bit about some of the risk mitigation strategies. I'll start, but then I'm going to pass it over to Betty. So from the perspective of the borrower, we're getting a lot from this by working with our partners. We know them well. We've worked with them on other things before. We know that if we lean back, we're falling into the arms of this community. It's not from outside. This is non-extractive investing. And also because of the lenders are working together and they know each other, we also feel like we're part of a community that if anything goes sideways, we've got a lot of people willing to really think about what might come up and then solve for those things. So that is really an assurance for us and for our board. Another thing is, because I had mentioned this for our preservation projects, but like we're also able to achieve a blended rate that's lower than market. The different impact investors have different terms. But you know what? That's okay. We've figured out what terms they're going to use and we made it work into a blend. The other thing is we're able to be a little bit more creative with the terms that we need. So I already gave the example of, instead of putting down equity, our deferred fees serves to meet the lender's requirement to have some sort of equity in the deal. Plus, because we have the CLT funds that provided some of that grant funding, that also stretches our equity. The other thing is we're really committed to working, all of the folks involved are local vendors, including our general contractor who's building. So, but this is a person who hasn't been in the field that long and isn't able to get bonded, right? So that could be a deal breaker. But actually, because we have impact investors who care about the vendors as well, we were able to come up with an alternative for how to make sure there's enough money in his account so that we never feel like we're at risk. But that's not the same as a bond or a letter of credit. So it's a little bit risky, but we feel really, again, held by the community to understand that there are other ways of achieving these goals. So there's a couple of examples of how we can we can approach the terms a little bit differently. I'm going to pass it to you, Betty, and happy to answer any more questions after.
Yeah, thanks, Meredith, for the overview of this project. We're so excited for it. And, we're like sitting on pins and needles to close so that you can go start. So just from the lender perspective, right? One of the reasons we particularly like this transaction, we co-invest a lot in real estate deals because we don't have the per deal amount, right, to make the biggest impact. Like our cap is 2 million on any individual deal, and we want to spread the risk across multiple investments. So this one with 4 mission aligned lenders coming together, right? Again, BI, LEAF, Boston Ujima Project, the CLT fund, alongside the city of Boston, right, with that subsidy, creates a ideal stack where we've diffused, right, the risk across multiple balance sheets, and we share the same goal, right? So to your point, if we have to problem solve together, we're not all like in our silo negotiating with ourselves. We're doing it as a collective. The other is, we talked about subsidy. I know we're going to go deeper on subsidy, but that's essential, right? These projects all require some kind of government or philanthropic subsidy to make them pencil, especially if you want to have deep affordability. And Meredith, I think when you walked me through this project, the affordability is significant, meaning like these units, while they are deed restricted, they're being sold at almost half of what the market price would be. And Boston is an extremely expensive market. Kate, and David, I was jealous of your price, your rents, because that does not exist here in Boston. So the other thing I'll point out is integrated capital. We are an integrated capital investor. This is a great example of how we're using different kinds of capital right across the stack, from debt, different kinds of debt, grants, and what looks like equity to be able to make this pencil. And it's deep, it's patient and affordable capital. In this case, because the units are going to get sold quickly, it's not a long-term loan. We're actually getting paid back really fast, right? But in other deals that are rentals or NOAA acquisitions, being able to have long-term capital, right, to the developer is really important. And then the last thing, I'll put a plug in that in this case, we're doing shared pro bono legal, right, across the lender organization. So we've often talked about, why do we have all these separate processes, separate documents? It makes it so hard for the borrower. So we're working hard, right, to figure out, could we have a standardized loan agreement? We might have different terms, but the base of that agreement is the same. And we have legal counsel, right, that is shared because we're all sitting in the same position and we can agree, right, to shared representation. So that's another opportunity to mitigate costs for the borrower and the lenders and to create efficiencies in the process.
I just want to add one quick thing, which is the community process. Like, all of these mission aligned investors have their own community investment board. And some go even further, like UGMA went through a whole democratic vote where over 65% of their members voted on this. So that means there's a great opportunity to educate on what this is all about, what the CLT is about, what impact investing is about. And that is a meta level of the work we're all trying to do. So that's been really rewarding as well.
All right. So I'm going to try to combine some questions because we're running short on time. I feel like we talked a fair amount about subsidies, so I'm going to ask about scaling, I think, and sort of a lot of this. And actually, the case studies somewhat feel like this. These are very these end up being bespoke projects, right? So, how do you go from a bespoke model to where impact investing is investing? I assume that's the goal, right? The goal is that right now, impact investing is the exception to the rule, and you would want it to be the rule. And that might involve policy, might involve all sorts of things. But, any thoughts about, obviously, 15 years ago, there was no Boston Impact Initiative, there was no Seed Commons. There's been a lot of progress in the field, but sometimes you feel like you're having to run faster and faster just to stay at pace, right? So I want to throw it to Shelby first and then have other folks jump in, and then I'll send it to audience questions because there are some really good questions for the audience.
I don't know that I am the best person to answer this right away, because I think that my answer might be too simplistic. I think that you hit on something, Steve, that every project that we're talking about so far is bespoke, right? And so the practitioners in the room, right? I think that the call outs there, and the question that comes to my mind would be, what are some of the levers that are available to pull that could hint at scalability? And maybe now this might be off base, so correct me if I'm wrong, but the Road to Housing bill could have just made things a little bit squishier. So Steve, I appreciate you reaching out to me, but I think that I would love to hear from some other folks about where they see scalability in because things keep getting more complicated.
Yeah, fair enough. We'll throw it to everyone else. So who wants to jump in? And you know, I mean, these projects are amazing on one level, and it's like a lot of the amount of work that has to be done because of the different layers and stuff is
Sure.
a challenge.
Yeah, I mean, I think there's a couple of things that I would throw out or I would offer. One is that this question of scalability and the way that we stack together investment from lots of different impact investors in a way that actually benefits the end, like the workers of the cooperatives that we fund. That's part of where Seed Commons actually came from, right? Was this understanding that for us to be able to do the work that we wanted to do in Baltimore, it was functionally more difficult for us to create just an infrastructure to do this into Baltimore and raise the capital that was necessary to fund our Baltimore projects. And that actually, if we created something that was larger, that was a bigger portfolio that would leverage the risk for investors across a very broad base of projects, we were actually going to be more successful in bringing investment into something that was a shared resource. So for us, part of the answer is in building the right investment vehicles that are able to bring together, like Meredith is saying, all of these different kinds of impact investment that is going to come in at different rates with different expectations and et cetera, and to try and build an infrastructure so that we're not necessarily putting the onus for stacking all of that stuff together on the individual borrowers, right? So the land trust is bigger, it's more established, it has more experience. When Water Bottle started doing this work, I think that the idea of them trying to figure out how do we stack together all of these different individual investors, like now I think they probably could start to do it, but at the beginning it was very, very challenging, right? And so for us, that's a part of the role that we play, is actually trying to ease some of that burden so that every individual bespoke project that we're working with in the housing space across the country is not necessarily starting at square one, is not necessarily having to go out and make all of those direct relationships. When they get to the point of maturity and they have the experience and the capacity and the enthusiasm to go out and do that, it's our job to support them in doing it, just like this collaborative of lenders that's coming together to make this project in Boston possible. But at the beginning, for us, we've tried to kind of ease that burden. And I think that's actually a really important piece around scale.
Thanks.
I'll offer, three things just to double click on your comment, Kate, right? Like it's a capital. I mean, there's been a lot of talk about a capital aggregator for real estate transactions, right? Like that could both be large enough in terms of low cost capital, but to be able to move fast, right? Especially with acquisitions, and to be able to do that blended or integrated capital approach, right? So I agree that that could be, right? A way to address the scalability challenge. And, you probably need many of these aggregators because real estate investing tends to be very localized and place-based. The second is the subsidy issue and how you scale subsidy. The Boston one is feasible because the city of Boston has a larger budget, can put in more subsidy, has actually created different funds, right, for real estate. But if you look at other municipalities, they just don't have the same municipal budget or the resources. And so we may have to look at both local level and state level subsidies, and that leverage state and federal dollars. So that's another key challenge. And that one is very much interconnected with policy and advocacy, because you have to advocate for the funds in the state budget and you have to advocate federally as well. And then the last thing I'll offer is that, we talked about this really earlier, is the shift in narrative, right, around who carries the risk and who benefits from the return, right? So often these deals are seen as riskier, right? Like, will they perform? And so it's like, sorry. So, what story do you want to choose, right? And I think we have to reassess investors, narrative about what risk and return is really like, because what's the risk of not investing in these projects and opportunities, right, that are desperately needed? We in Boston are in the midst of a housing crisis. We need 220,000 more units to be able to house, right, and meet the need here. So we got to move fast, and that means putting all kinds of capital into.
Great, thanks. I'm going to start moving to audience questions. There's some really good ones. This one says, this kind of follows in a way. I've recently moved out of the co-op world and into a state housing department. There's some work going on here figuring out how to create more funding opportunities for housing co-ops and also resident cooperatives that manufactured housing. But there's a gap in that, some of the affordable housing nonprofits, the developers, if you will, might not be prepared to provide technical assistance on the co-op side of the work. So, there's the governance piece and there's the development piece, and bringing those together can be challenging. What ideas do you have for bridging this gap, and does this gap come up at all in your work?
So first of all, hi, Justine. But second of all, I think that this comes up all of the time. Like the challenge of doing cooperative development, whatever context it's in, if it's in the context of a business, if it's in the context of a housing development, if it's in the context of a producer's cooperative, like at the end of the day, you are both figuring out how to invest the time and energy into developing a successful and sustainable business, and in how to develop a successful and sustainable community of individuals who are going to work together in ways that are democratic. And so there's a lot that goes into it. So one of the things that we really advocate for a lot of our members in Seed Commons, so again, these are going to be the the individual organizations, community-rooted organizations that are working as the local agents for the loans that Seed Commons is making. A lot of times they will bring things in that are in the kind of affordable housing space. And one of the first things that we'll say is there a partner organization? Is there anybody you can be working with on the ground so that you're bringing the cooperative expertise and you're doing that with the support of Seed Commons and the national backbone staff to help train and support you through that. But there is there's an organization on the ground that has already a foothold in the housing space or in the real estate space. We're actually really big believers in partnerships. I think partnerships are the way that we actually get things done. It's really, really hard for the work that we do to be housing experts and business experts and restaurant experts and et cetera, et cetera, et cetera, and also be able to do co-op development. So realistically, I think being able to rely on bringing expertise in a way that really benefits the end product, I think is good. But there's a certain amount of education that has to go along with that, right? So, we can have an affordable housing developer who gets really excited about like the concept of co-ops, but we actually need to be able to come in and train them on what does that mean? What does it mean to be a co-op? And they often have a lot of questions about like, isn't that really risky? And so we have to actually workshop it and go all the way through so that they fully understand. And I think just the last piece is that we really always take a train the trainer approach. So for us, the distribution and dissemination of knowledge and skill around cooperative development, but also around business development is really important. The best people to teach affordable housing developers how to make co-ops are to get people who have been through the process of being a part of a co-op or a CLT or a community ownership vehicle to be the ones doing the teaching. They're really the experts on how to do this, right? It's not me. It's David and the team at Water Bottle who now have to be going out and teaching people in other cities. Well, how did we do this? What are the lessons that we learned?
Great, thanks. So I think there's a couple questions one that's sort of, I think, geared towards David and one that's geared towards Meredith. So I'm going to try to do these quickly. David, in Baltimore, how are you working with the city around Reframe Baltimore? And somebody makes a comment that it's a unique municipal financing scheme of some sort. So you would know more about that than I would. And Meredith, there was a question for you about if you're using modular development for the 365 Park project, and how's that working, given that's a growing source or strategy for affordable housing.
Reframe Baltimore. I saw that question in the comments, and it was linked to Baltimore's tax TIF pilot, tax increment financing. That just rolled out last year, and it was a fast rollout, and it's an early design right now. So I think it's a really promising. It will be a really promising source of investment towards rebuilding vacants in the future, but it's not yet. In the meantime, the current mayor and city council of Baltimore and the current governor of Maryland have committed serious efforts to affordable housing and to rebuilding Baltimore's vacants, and that is manifested in a variety of other funds that we are starting to have some limited success securing, but it's painfully lower success than what we feel we should be getting, because we are a community anchored, highly impactful developer getting kind of scant dollars from the government in the form of grant. And I asked the question, well, why is that? And it really comes down to because we are a cooperative, and so far government grants the politicians are excited about cooperatives, but so far, like, the policy hasn't caught up. But we're getting there. We have a lot of great conversations going on with the grant administrators, and even the Maryland Secretary of DHCD is going to come walk about with us in a couple of weeks. So I have a feeling we'll get there. I hope that answers your question.
Thanks. Meredith, anything?
We are not using modular. It's definitely a very compelling idea. This is our very first development project, so it's something we're going to keep our ear to the ground on. And our development partner, Co-Everything, is truly resourceful with the materials they're using. But yeah, I'll take the question to the field as we think about our next project.
Got it. All right. This is kind of an interesting question. It's fairly general, so anyone can jump in. It's basically asking, or noting that sometimes subsidies come along with strings. So everybody wants subsidy dollars. They don't always want the requirements that are tied to those subsidy dollars. And sometimes those can actually make the subsidy itself counterproductive. So what have been some strings that have been easy to meet, and what are some that are harder to meet, and any tips for dealing with the latter?
I guess I could start, because we do rely on subsidy. The subsidies that come in with the acquisition or development are fairly straightforward. It's basically a deed restriction. And because our organization is all about long-term affordability, that's an easy lift for us. I think the harder ones are because we also need operational subsidies that really helps us keep our projects running smoothly and financially stable. And that comes with a lot of invasive regulation. So compliance ends up being a really big part of the way we have to run our properties, and that can get in the way of community governance. So yeah, the subsidies help. We have some people who don't even have an income at all. And so because we have the public subsidy, they're able to live there. And that's awesome. But it does mean there's a lot of invasive inspections that we don't have control over. And it also requires a ton of paperwork. So it would be lovely not to have to use those subsidies at all. I think it would really reinforce our community governance standard. But it's one of those trade-offs that we grapple with.
I'd like to second the motion to find another way to find subsidy. The restrictions themselves with respect to affordability, we're all about it. We want it. But then we found ourselves in grant contracts where we were supposed to provide the deeply affordable 30% AMI housing, and the city was supposed to supply supportive services for folks that need that and vouchers. And then when we finally got into our buildings built, the city would say things like, "Oh, but there's too many vacants on your block. We're not sending the vouchers. And by the way, you also don't qualify because you're a cooperative and a nonprofit for the supportive housing links either. But you still are required to meet that affordable housing requirement." So, like, no bad intentions on anybody's part here, but it's just like trying to fit stuff together that just isn't fitting together very well.
Right. Thanks. This is an interesting question. So the question is, do you ever work with investors seeking market rate returns as part of your capital stock? And the person's particularly interested in pension funds because, of course, these are usually from public workers, often have at least a formal mission to support the people of the state. So any ability to, this is a potential scaling strategy, obviously, and also pension funds can be really difficult to work with. So any thoughts on that?
I mean, I think this is a big area of conversation in the space of those of us who work with impact investors or run impact funds. I think that I do think there are some challenges. One of the places that seems kind of promising is working with some of the unions to actually think about how to redirect small portions of the union pension funds into these kinds of aggregators, like a Seed Commons or a Boston Impact Initiative or something like that. That's the place I think we're most likely to get a foothold. But I think at the end of the day, the work that we do isn't going to work if the expectation is a market rate return. So I think for us, where working with pension funds might be viable is where they are willing to set aside a small portion of that and expect a smaller return on a small portion. Because, something like a union pension fund, again, like it's a lot of money. We're talking about like millions and millions of dollars. So if there's a small portion of that that's carved off to be put into like a specific fund for doing impact investing in the housing space, it's not gonna hurt the performance of the overall portfolio.
Yeah, and I'll just emphasize it's millions of dollars. It's I think $6 trillion that's in public pension funds. So it's a lot of money. I haven't looked it up recently, but that sounds about right. Another interesting question was about obviously there's a affordable housing crisis nationally, or at least in many communities across the nation. Are any of the presenters that's asking partnering with faith communities? Of course, there have been in some places, notably in California, but I think in other places as well, measures to try to encourage religious congregations to make use of their land for affordable housing.
I mean, one of the properties that we fund in Baltimore actually is it's an affordable housing project called Volar Village of Love and Resistance. They're in East Baltimore. And the site that they are working on, so it's community-owned real estate, community-led real estate development in an area of the city that was really kind of pushed out by the expansion of the universities and the biotech facilities. So Baltimore is a big site for medical and biotech research through University of Maryland and Johns Hopkins. And there was this huge displacement of East Baltimore residents. And out of that organizing came the creation of this community investment cooperative and community real estate cooperative, which is called Volar. And the first site that they acquired actually is it's a church. So it's two buildings, a historic church in East Baltimore, and they were able to work with the congregation that had dwindled and had gotten very small and was going to consolidate with another congregation in the same region to be able to take over that piece of real estate and turn it into affordable housing. So it happens, but But the only place that I've really seen it happening on like a bigger scale is in some of the organizing that's happening with like the Franciscan Sisters of Mary, right? So the work that the radical nuns are doing to think about how to refocus the holdings of the Catholic Church in the United States, which are very, very vast. This was like an individual faith-based space that was acquired, but thinking on a more global scale, or at least a more national scale, I think it's probably the radical Catholic organizing is where we're going to see that the most.
Great, thanks. There's a somewhat similar question about hospitals. Of course, the Affordable Care Act does create some incentives for hospitals to invest in healthy housing and so forth. There's a network called the Healthcare Acre Network that I'm sure some of you have heard of. Have any of you actually seen hospitals invest in any of your projects ever?
We have for our preservation, because it is considered an upstream way to address the impact of housing quality benefits people's health. So we have received hospital funding and investment in our projects, and we hope to continue to do that.
Yeah, I mean, in Boston, the large hospitals do now co-invest, right? Could be individual projects, but also into funds, and housing, workforce, supporting small businesses, especially around food access. Those are all themes, right, that lend themselves to using hospital community benefits monies or other grant funding. So it is a really good opportunity to leverage, and some, because it is a social determinant of health, right? Having safe, affordable, healthy living conditions and housing, it's definitely a source to tap into.
Okay, I'm trying to squeeze one more audience question and last question for the panelists. So audience question, this one's about legal requirements for building materials, some of which got changed in the housing bill that was just passed, right? Like with Chasey requirements being loosened for manufactured housing. Are there restrictions that, do you see possibilities within the housing bill to expand affordable housing, and or places where there are still blockages that you would like to see changed from like a supply, building materials standpoint? David?
Yeah, I just haven't. The main thing we were watching for the bill was this thing was about a potentially bad thing where they were trying to limit the number of corporate owners of scatter site buildings, which could have been bad for us, especially because we are thinking about how to scale this sort of scatter site model. But the folks at NCBA and USFWC have assured us that they saw that, they worked on it, and they made sure that co-ops were excluded from that provision. So, but that's the extent to that I dove into that bill. I otherwise didn't see it having much impact on what we do.
Okay. One last question for all of you. Are there any specific steps that housing advocates and impact investors can take to change the field of impact investing so that it better realizes its promise? So you each have like a minute, so it's a complicated question, but any last words of wisdom you want to share? Maybe I'll throw it to Shelby just to give you a chance to jump in.
If you're asking for ideas, that's again not, I would love to hear what other folks are doing. I have a lot of folks that when I talk to people out in the field, they are looking for help. So, so if you guys have answers, I'm all ears.
All right.
I'll kick off. So for the housing advocates, because we work with, a few, I think the thing they do really well is mobilize and educate tenants, right, around ownership, around the possibility of owning, especially, if a landlord is going to sell the building that they're living in. So I think that's where we're seeing opportunities to keep naturally affordable housing like in play. But it takes a lot of education, moving quickly, and the advocates can help organize, right? For the impact investors and funders, we've talked a lot about like we need more low cost blended capital to do these transactions. And so, for investors that are looking like, I want market rate return, like, is there a possibility of isolating a pool of funds, especially if you're a foundation, right? Or you, like you said, pension funds, like it is beneficial, like the return on your investment when you can keep people housed in your community is much greater than the additional percentage points you're going to get. So rethinking risk and return is really important. Helping funds like ours, like Kate's and ours, like we're trying to aggregate capital. So introductions to other investors, mobilizing wealth holders to move in this way is really critical. Donor advised funds are another tool, right? But we need the infrastructure, the piping they have to facilitate impact investments. And then we didn't get to talk a lot about policy, but policy is hugely important, right? Because both it's a funding mechanism for these kinds of transactions, but some things do need to change, right? Like even opportunities to own. There's a bill here for many years we've been trying to pass TOPA, right? Tenant opportunity to own, rights of first refusal, right? For community organizations to be able to buy a property so it doesn't go into corporate hands. There's a number of policy levers, right? From zoning to where you get to develop and how that need to be part of the whole solution. So that's what I would say.
I can jump in. I love those suggestions from Betty and other ones that came up earlier. I do think having longer horizon, because it's much easier to get the short-term money, but we really need the longer-term money. Kate, I liked when you gave the 30-year right from the get-go. That's brilliant. More of that would be great. And even just expanding the horizon from 5 to 7 to 10 years as a first step, and then even longer as we go. I think that would be huge. Also, we had the experience of starting something called Small Properties Acquisition Fund in Massachusetts. That was simply us talking about what do we need, and then we worked with legislators and we got the thing passed, and it resulted in we're looking for more money, but it did result, we were able to benefit. We got to the finish line of a project because of that policy. So I think hearing the investors on this call say how important the public money is to allow them to leverage their resources means we all need to be part of the policy conversation as well, because we can tell that story. Yes, state, city, if you can give us more money, we can get more money from the investors and we can do a whole lot more housing.
Great. Well, I think we are at time. So much as we could, just scratch the surface, I know there's a lot more that we can talk about. I did put the panelists' emails in the chat, so you can get those if you like. And I want to thank our panelists who gave us a very rich discussion today. Betty Francisco from Boston Impact Initiative, Meredith Levy from Boston Neighborhood Community Land Trust, Kate Khatib from Seed Commons, David Lids from Water Bottle Co-op, and Shelby King, our investigative reporter at Shelterforce. So thanks to all of you, and thanks to everyone who attended for your excellent questions.